Hi, everyone. This is Tim Melvin of the Tim Melvin Deep Value Report coming to you from down here in Central Florida on a nice Saturday afternoon. How do you guys like my new whiz bang headset? This thing's got so many controls. I feel like I should be guiding the lunar module down to the moon's surface, or at least guiding a NASCAR team around the track at Daytona. Had a long-time listener point out that the noise and sound quality of not using a headset was just not good enough, and I needed to do something about that. Ordinarily, I ignore these types of concerns, but this longtime listener happened to be my wife. So off to Best Buy we went, and new whiz bang special headset that was actually designed for computer gamers to get the sound a little bit better. Anyway, flattish week in the S&P 500. It looked like we were going to have a strong week until we got to Wednesday and the SALT conference out in Las Vegas, and things changed rather quickly. The big news really this week doesn't come to us from the stock market, but that really strong 2% move in the TLT ETF, as the bond market just does not like what it is seeing from the U.S. economy. The reports that came in this week were a pretty mixed bag. We're continuing to be in that better but not really good environment. And the bond market's telling us that, hey, it wasn't just the weather, folks. Things are actually not that great out there. Now, that's very similar to what David Tepper of Appaloosa Management said at the SALT conference in Las Vegas that really started stocks tumbling down on Thursday. He said that he was nervous about the market, later revealed to CNBC that he was only 60% in stocks as opposed to 100% 6 months ago. Now, this shocked a lot of people because David Tepper has been one of the few guys standing there being wildly bullish, advising investors to be fully into stocks. Don't fight the Fed. The economy is recovering somewhat, and it's time to own stocks. And as a result, he's put on just a tremendous performance over the last 3 years, racking up returns for investors in his hedge fund. Now, for this Super Bowl to come out and say, hey, folks, it's time to be nervous. There's a time to make money and a time to not lose money. And right now it's time to not lose money. Shook some people up. And we saw quite a little sell-off on Thursday. We'll see next week if we get any type of follow-through for that. But Mr. Tepper is saying something that we've been saying for a while. There is a disconnect between where the stock market is and the level of real economic activity. Either the economy has to get stronger real fast, or we could see stock prices come down to reflect the actual reality of things. Mr. Tepper wasn't the only one a little bit nervous about stock prices. David Rubenstein of Carlyle Group, the private equity fund, and of course, as you know, I like to follow what the private equity guys are doing and thinking. It's the smart, patient money. We like to adopt that private equity mindset. He said that the market was frothy. It's actually hard to find deals, and the deal multiples are all the way back up to 2007 levels. And there's more leverage in buyout deals right now than there was then. Back then deals were going about 3 times. We're seeing 5 times leverage right now because of the very low interest rates. High leverage and high prices. We've seen the movie before. It doesn't end well. We'll see how it plays out this time, but I suspect that he's right. The market's frothy. Need a pullback in the asset prices across the board. The biggest bull was Leon Cooperman of Omega Advisors, who has also racked up a pretty solid track record over the last couple of decades. But important to understand, he was bullish simply because stocks are the only game in town. He referred to buying treasury bonds in particular as picking up dimes in front of a bulldozer. And he thinks that the stocks might get as high as 2,000 and won't go below about 1,700 on the S&P 500. Not a raging return from current levels, but as he said, he thinks it's the only game in town if you have money to invest. That, in my experience, is a horrible reason to own stocks. We like to stick with, are there cheap stocks? Are there not cheap stocks? Right now, we're closer to not a lot of inventory out there that fits our safe and cheap parameters. As a result, we're holding high levels of cash in most of the portfolios at this point in time. Now, today in Barron's, as I was skimming through it, I was interested to see an interview with 2 of the principals of Colbert, Kravis, and Roberts, again, another private equity firm, and just kind of see what their take on the world is. If you haven't got it, go out and get a copy. It's a very interesting article, and there's some other good stuff in this week's edition of Barron's. Henry Kravis said that right now the world is awash in cash, and it's all looking for yield, and that is pushing down returns for private equity investors from the current levels. Both of the partners, George Roberts was in the interview as well, they think that the opportunities right now are in healthcare Energy, which is something we've talked about a lot, particularly the domestic unconventional oil fields, and that's where they've been raising some money. They like real estate, they like distressed debt. They also like direct lending, especially in Europe, because the European banks are so constrained by lending restrictions due to their somewhat troubled financial status that there's a huge market for direct lending. Leon Black of Apollo touched on this about a week ago. We're aggressively looking right now for a way to get some money into that particular idea on a safe and cheap basis because I agree with him. There's going to be some mid double digit high teens returns piled up in this sector over the next couple of years because there's a lot of demand for direct lending all across Europe. So we're looking at that one very, very closely. And George Roberts, interestingly, said something that kind of warmed my heart a little bit. He said if he was starting a firm today, he would focus on small real estate deals. Now, since we have a bunch of small real estate deals in all of our portfolios, I was pretty happy to hear that somebody as smart and as successful as him kind of agrees with us that that's an undervalued area of the market where it's worth paying some attention right now. They went on to say that they think that the market is fairly valued, not excessively cheap, not particularly overvalued. And then, really interesting, they said going forward from this level, they would expect about a 7% return for longer term investors. But more importantly, 2 to 3% of that return they think will come in the form of dividends. Now, we have the income portfolio that's exclusively devoted to the higher dividend paying stocks. But if you've noticed, if you're a subscriber, even in the last few purchases in the deep value portfolio, the majority of them have been dividend paying companies. I think dividends are going to be increasingly important going forward. And I like collecting that cash every quarter. That gives us a little bit of a buffer against market movements. So dividends, that's about 40% of the return that these two very smart, successful guys expect. So it might make sense for us to be paying a little bit more attention to finding safe and cheap opportunities that also pay a significant dividend. Roberts touched on the fact that sluggish growth is tied to what he calls the policy logjam in Washington, D.C. And we need a policy that doesn't try to make things fair or encourage certain interest rates, but a policy that allows businesses to create jobs going forward. Mr. Kravis said that the single biggest thing that could get this economy in launch mode is an overhaul of the tax code. He said it's ridiculously complicated and the current system actually hampers U.S. competitiveness. So that was kind of some interesting comments from these guys on how to get the economy jump started, where there's opportunity and what they think of the overall market. It's a worthy read. And as I said, there's some other great stuff in there, including an interview with Barry Rothstein of activist firm Jana Partners. And I'll let you read it for yourself, but a couple highlights that you need to be aware of. He says the market's not cheap at this level, but it's not egregiously overpriced either. He gave 3 ideas. One is in what is quickly becoming one of our favorite sectors of the market because we're finding so many safe and cheap stocks there, and that's energy, particularly the unconventional oil and gas fields here in the United States. Assets are incredibly cheap. Once we get more natural gas usage as part of our energy policy and we begin to export U.S. natural gas to Europe and other areas that need it, natural gas prices will get a lot higher and these companies will make a lot of money. Remember, I don't have a quarterly view of stocks, guys. I'm looking out 4 or 5 years. I think these things can be 5, 10, even more times the current price. A lot of them are very cheap, well below book value. There was one other important conference from our perspective as value investors with a fondness for small banks, and that was the Gulf South Bank Stock Conference that was held down in New Orleans. A lot of companies gave presentations. We're still working through those. We've got a bunch of the slide decks to look through. But one of the overriding themes was that there needs to be disciplined buying. You're seeing acquiring banks be very careful. They're passing on a lot of deals at certain multiples. That's why the current trade level is only about 1.3 times tangible book value. And the trend's not really accelerating as fast as some people might have hoped. Now, it is going to accelerate in the future. There's people that have to buy and there's people that have to sell, and eventually they're all going to get together. But right now, the buyers are showing some pretty good discipline. John Allison of Home Trust Bank, he said he's the largest shareholder in his bank, and he's simply not going to do a dumb deal. It has to be accretive to earnings. Now, we've got one portfolio company that is in the process of closing a merger with Home Trust, and we're going to take stock in the deal. So we're really glad to hear that. We're going to be stockholders in this thing. We don't want to see dumb deals. that eat away at book value and blow away the profits going forward. So some other banks that have been on the acquisition trail, we know are going to be serial acquirers and look to grow via acquisition, including banks like Iberia Bank and Bank of the Ozarks. Their CEO said pretty much the same thing. We're looking at deals every day. If we like them, we'll get them done. If we don't like the price, we don't like the assets, we're walking away. We're just not going to do any stupid buying. Although that does slows down the pace a little bit, overall, it's excellent for the long-term health of the banking community and gives us a great degree of confidence that the trade of the decade in the small community banks is going to work out very, very well, both for the banks and for those of us who are investing in these little bank stocks. Okay, big news week coming up. The most important one, some people say the Fed minutes. That's not it, folks. Vladimir Putin is traveling to China, and then he's attending a conference in Shanghai where they will be joined by the Iranian president, but he will be meeting with the premier in China, and they're going to talk about all kinds of ways for Russia and China to do some deals and financial stuff together. That's not good news for anybody, but I'll be real interested to see what, if any, news China lets out about these meetings and how this all plays out. So that's, again, from the long-term point of view, I think that's the most important news this week. We do get the Fed minutes, and we can sit around and psychoanalyze what we think they were thinking when they said what they said, and it will generally move the market around a little bit if there's any significant deviation from expectations. We have existing home sales out, I believe, on Thursday. I think that's going to be a very, very important number this week. New home sales have been flattish. There's a lot of discussion that the housing market is just not as strong as everybody had hoped it would be. And then, in fact, a lack of first-term and first-time move-up buyers is going to create a logjam and seriously impact the housing market. I'm kind of in that camp. I'm leaning that way. I see way too much building activity going on for what I also see going on in the jobs market and the economy. We'll see what that number looks like. This is the spring buying season. It should be a very good number. If it's not, it's going to be very problematic for the stock market. You have a Bank of Japan monetary policy meeting. Those are always fun and interesting. Nobody expects them to do much of anything at this go-round. You have a Ukrainian presidential election coming up. That should also be absolutely fascinating, given last week's referendum and the ongoing discussions between Russia and the Ukraine over separating the nation once again. Of course, it is the Memorial Day weekend, so we'll get a 3-day weekend, an extra day off next week. We'll be enjoying it down here in the Florida sunshine, I'm sure. And as we go into the week, the Orioles coming into today, they're still in first place. Got a 1-game lead over the New York Yankees. Although the Tigers came in and beat us up pretty bad earlier this week, they're now doing us the favor of continuing their beating on other teams, and they're picking on the Red Sox this week. That's always a good thing for me. We've got 2 more games with Kansas City, then we Pittsburgh and the Indians on the road. So that'll be a pretty interesting baseball week for us. Got lots of friends from Pittsburgh all over the country these days, and so we can always get some interesting discussions and debates go when those teams play. And we'll have this up before the race goes off. So I'll tell you, I've got my Pimlico picks in. Still playing with the winnings from Commanding Curve, sneaking home second in the Kentucky Derby. Today, you've got to use California Chrome in any mix of your bet. It is the best horse in the field by far. It's going to take an extraordinary event for this horse not to win this race. However, if you mix it up with Social Inclusion, the 8 horse, California Chrome, by the way, is coming out of the 3 slot, so that'll be the 3 horse. And then I like Kid Cruz, a 20-1 long shot coming out of the 7 hole. He's not one of the fastest horses in the race, but he's got an extraordinarily good pedigree. He's done very well, and he's capable of coming on late. Any combination of these horses getting in first or second is going to spell a good day for me. Should it be the 7 horse first and the 8 first horse last, it will be a fantastic day for me at the racetrack. But we'll see how that plays out when these horses go off around 6:30 this evening. Anyway, this has been Tim Melvin from the Tim Melvin Deep Value Report and Banking on Profits down here in Central Florida. I'm off to enjoy the rest of the weekend. I'm going to hit up the Orlando Central Library's half-price book sale. That's always good. And hopefully we get a little pool and reading time in this weekend. Enjoy your weekend. I'll talk to you guys next week.